Hey everybody, Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. And last week we talked about bonds and inflation. This week we're going to talk about stocks and inflation and why it's so important for the stock market to hide the erosion of purchasing power. So first you're looking at the cumulative inflation chart, and you can see how that's gone exponential once we went completely off the gold standard. Okay? Now,
cumulative inflation since 1910.
13. Okay. Well, it's actually from 1913, and the furthest this one went out was 2015. And remember, there are links below so you can see these images in JPEG form. Okay? Now, this shows you the same thing, just a little differently, but what I wanted to particularly point out was the times when we had a money standard shift, because we're already in the process of that. So you can see this one, which is when we shifted from a gold standard to the beginning of the fiat money standard, and then you can also see, I'm looking at it backwards, this one, that's okay. This area in here, 70s through the early 80s, where we shifted from a fiat monies, from a kind of gold fiat money standard to a pure fiat money standard. So can you see the rates of inflation when we shifted? Okay, that's important for you to recognize as well. So the first one was cumulative. All right, now we're going to talk about stocks, etc. So I pulled up this wonderful graph on who I'm going to say actually thinks they own stocks. And what you should be able to see from this is the very strong transition from ownership outside of retirement plans to ownership inside of retirement plans. So really, much of what we are looking at here, that's where the normal person holds their wealth. IRAs, 401ks, 403bs, etc. Pre-tax dollars in this system. Now, if the stock market, you get your statement and you open it up and the statement looks okay, then you think, well, everything must be okay. But there are many, many reasons why they needed to look okay. Now, in this particular graph, it shows you your real rate of return. This is inflation. And then these are the taxes that you pay, so you can see that those go up as well, even on the dividends. And then look at this lovely line here, the fees. So remember we talked about that nominal confusion piece. What you're looking at is the stock market going up and you're thinking, oh, aren't I doing well? But in reality, when you take into account all these different taxes and inflation, etc., you're not doing very well at all. But Wall Street is, because those fees are guaranteed. Your returns are not guaranteed. And it is simply your perception that you own something when you have your money positioned inside of the stock market. It is actually, according to Yale Law Study, this is you down here. You're the beneficial owner. The legal registered owner, if you have something, you want to put that up?
Yeah.
If you have something inside of a brokerage, insurance, bank, etc., if you don't hold it, you don't own it. It's just your perception, and you're the beneficial owner. But all these guys between DTC or Seed and Company and you are also beneficial owners. And they get to use any equity inside of those accounts for their own benefit. They can borrow against it and then do anything they want with the money. That's called hypothecation. And you can see from this bar chart how much, particularly JP Morgan, Morgan Stanley, etc., how much they use your equity for their benefits. It's a big part of their trading revenue and their revenues. But what you also need to understand about it is that they can do it if they create this contract through the City of London, which is where most of them are done. There are no limits to how many times that same equity can be used. And that's called rehypothecation. That's all about leverage. Okay. On top of that, you can see in this derivative graph, and you guys have probably seen this before if you've been watching the webinars, how much they can create brand new speculative products from the rise in the stock market. And in fact, this one is from the Office of the Comptroller of the Currency, and it's just showing you derivatives against equities. And look at where we are for 2016. They generate an awful lot of money by borrowing your equity and then leveraging it and making bets against it, which is what makes it so vulnerable. Any wealth held inside of this fictitious fiat money system, that's what makes it vulnerable. And I hope that you can see this. So, nominal confusion, right? You see the stock market, 11 days, oops, upside down, sorry about that. 11 days in a row.
Yeah, it looked a lot worse before.
Right. Sorry about that. Those gains. But what I want to point out is over here, right there, long-term capital management, that was the first speculative derivative bubble. So in derivatives. So they pushed the NASDAQ up, and look what happened to that speculative bubble when it burst. This one is from 2008. So you see that we are at extreme levels with a ton of correlation. I mean, all of those graphs pretty much look alike. But this, technically speaking, this is what's happening with official inflation. And you can see, all right, now here we go. A wedge formation, and you can think of it like a piece of pie where you're broader at the back and then you go narrow. So what we see in these inflation numbers are a wedge formation occurring. At some point, this will, and a wedge formation, I don't care what chart you're looking at, you'll see a series of higher lows and lower highs, which is exactly what we see here. At some point, this breaks out. If it breaks out, if a wedge formation breaks out to the upside, then that means it's going to keep going up. If it breaks out to the downside, then it's most likely to keep going down technically. But we finally hit officially 2.5% inflation. And they're thinking this is a really good thing. If they could keep control of it, which they can't, and that's not really what the intention is anyway, then they'll just keep it at a rate that you don't notice and continue to use all of those tools for nominal confusion, where you're looking at a number, but you're not understanding the valuation of the dollar underneath. So I hope that helped clarify why they want inflation and why inflation is good for the central banks, the governments, and certainly all of the other banks. And just go ahead and subscribe to our YouTube. We'll let you know when we're doing these live events. Like us on Facebook, follow us on Twitter, and give us a call, 888-696-4653.
And then also, the links won't be up until Monday because Bill is not here to put the links up today.
Okay. So they'll be up on Monday. And also, I'll let you know that you're going to see more charts in there, and I'll probably do that from here forward anyway, on charts that I didn't use, but that I pulled. So until next time, be safe this weekend. Bye-bye.